Turn to page 40 of my handout. I don't say much about this, other than the equity method is also a timing difference. Now, let me explain to you the equity method if you have not had investments yet. Well, you should remember this from school. So, all right, this is the equity method. If I own 20% or more interest in another company's stock, I have to record the investment under the equity method. So, let's assume the company I invested in has net income of $100,000, and also they pay dividends out of $30,000. So, what do I have to do here? Well, if I own 20%, 20% of the net income is $100,000, $20,000. So, my entry that goes on the books is debit investment by $20,000, and we credit an income statement account called equity in earnings. $20,000. Now, they pay dividends of 30 to everyone. My share is 20. 20% of 30 is 6,000. Debit cash for 6,000. Under the equity method, when you receive a dividend, it's a return of investment. And this is discussed in detail in the investment chapter. Now, what does this all mean? Well, equity in earnings is book income. It's never taxable income. But when they pay you a dividend, that is on the tax return. Now, this is our total share of the other company's earnings. So far, we've received 6 of this 20 paid to us in cash. So, if all undistributed earnings are going to be paid to us in the future, they still owe us $14,000 in the future. So, we are owed future earnings of $14,000. Now, when we receive these future earnings, they're going to be dividends. And dividends get a dividend received deduction. So the rule is, if I own 20%, the dividend received deduction is 80% of the dividends. So I can exclude 80% of the dividends. They'll tell you in the question. So I take 14,000 times 80%, and that's $11,200. So now my future taxable amount is going to be the difference between the 14 and the 11,200. It's going to be $2,800. Now let's assume the tax rate in the future, this is never going to happen, the tax rate is going to be 10%. So what do we know? Future taxable amounts times future tax rates give us what? A deferred tax liability. Future taxable amounts times future tax rates gives us a deferred tax liability of $280. So what would my entry be on my books? Well, I would credit deferred tax liability for $280, and I would debit income tax expense deferred for $280. So that's how the equity method works. So to make sure you understand that,